Hey, good morning, everyone. Welcome to this Thursday, September 7th, 2023 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be with you here for the next maybe about 25 minutes or so. We're going to have a shorter version today, but I'll be here to go over everything happening this morning, trying to give you an update on things. Sorry, I got things going just a little bit late this morning. I actually was trying to finish up a user-defined index on the IWM versus the QQQ, which I want to share with you a little bit later in the show. Literally, it was coming down the last second, so I just need a few more seconds to get that going. But I do want to welcome everyone. For those of you who are new to our live stream, new to EarningsBeats.com, welcome. We certainly appreciate you joining us today. For all of those who have been following us through the EB Digest newsletter, and have followed our shows, my articles over at StockCharts and my Trading Places Live blog and so forth. Really appreciate all of your support and loyalty over the years, and absolutely, most definitely, want to thank all of our members who have helped support us over the years and really enable us to do what we do. And I really love to educate. I love to talk about the market. My views a little bit different than a lot of folks out there, as I think you probably have recognized over the past few years. We do a lot of research, a lot of independent research here at EarningsBeats, and I really think that helps us in terms of calling the market better than most, maybe better than all. I don't know that anyone out there has called it better than we have over the past few years, and I certainly think a lot of our independent research leads to that. Let's go ahead and get things started, because as I said, I do have a meeting this morning, so I really want to try to get out of here a little bit early today. So hang in there with me one second. All right, you should have the screen up now showing a lot of the indices, sectors, and industry groups from yesterday's action. So on Wednesday, it was not a very good day, but there was some subtle rotation back away from the Nasdaq. I really think the Nasdaq's got some issues going forward. I'm going to talk about those a little bit. And I'm not saying the Nasdaq isn't going to go higher. I think it's going to be a little bit more difficult, because I think some of the leading groups within the Nasdaq could have some problems doing much more than consolidating for a while. And maybe I'm wrong, but based on what I'm seeing, I think the Nasdaq is an area that we want to be a little careful with, especially as we go into year end here in 2023. Dow Jones Industrial Average down about 0.6%. S&P 500 down 0.7%. Nasdaq down 0.9%. Mid caps and small caps actually did a little better on a relative basis. It was weird because I think a few days ago they did really well on a relative basis. Then I think 2 days ago they were horrible on a relative basis. Well, yesterday they picked back up. They showed a little bit of relative strength, even though all the major indices were lower. Mid caps down 0.3%. The IWM, which tracks small cap Russell 2000, down a little bit more than 1/3%. Transports down about 0.75%. So clearly across the board, another down day. I think part of this sideways consolidation that we helped to spot back in July said that this was something we certainly could expect. Not only were the technicals and some of the sentiment indicators showing that, but history tells us the worst period during the calendar year is July 17th to September 26th. It's September, what did I say, 7th today? So we still got a little less than 3 weeks to go to get past this period. And throughout this period, July 17th to September 26th, the worst period is once we get past September 15th. So keep that in mind. It's not a guarantee. Market doesn't go down every year between September 15th and September 27th. But historically, this is the worst period. That's what history tells us. So we've got to at least be aware of what potentially could lie ahead. I find it very interesting that we're going to get the CPI, the PPI, and a Fed meeting all during that period. Any kind of signs that inflation might be a little higher than expected, even if it's temporary, I think could spell trouble for the market. So just keep that in mind as you trade here over the next few weeks. Moving on to the sectors, utilities. I think energy may have been another sector that was up yesterday, but utilities was the winner, if you want to call it that, rising about 0.25%. To the downside, a couple of those key areas for the Nasdaq: technology, consumer discretionary. They were your laggards, the primary laggards. Technology dropped a little more than 1%, and discretionary dropped about 0.9%. Moving to the individual industry groups, home builders been very, very volatile of late. I think this is a group that is trending lower. I would be really careful, especially if we lose 1800. 1800, a little bit of a neckline, downtrending neckline of this potential topping pattern: left shoulder, neckline, head, right side of the neckline, down sloping, right shoulder pretty symmetrical with the left shoulder, but we are rolling back over. Watch 1800. This group could really take a hit. It's been up a lot, more than 100% within the last year. And so if we break down below that 1800 level, don't be shocked to see a move back down into the 1600s. I think this is a group, and you might think, well, that doesn't make sense because interest rates, if you think inflation is going to remain in check and go lower, we should expect the 10-year Treasury yield to drop in anticipation of the Fed cutting somewhere down the road. Market doesn't always make sense. Remember, we've been going, what do we have? We have mortgage rates that have been the highest in probably the last couple of decades. And yet, what did the home builders do throughout that entire period? I mean, it was really just a month or so ago, less than that even, that we were up near the recent highs. So that was all done in a rising interest rate environment, which doesn't make a whole lot of sense. So if rates come down or start to come down, don't be surprised. This could be a buy on the rumor, sell on the news kind of a thing. So be careful with home construction, home builders. Moving on, I think this is the oil equipment index breaking out again. Do have a slight negative, well, not even slight, have a pretty good negative divergence on this group. Wouldn't be surprised to see a little pullback, maybe back down to around 315, 320 in time. But we did break out, close above 342 yesterday. That was good news. To the downside, one of the weakest areas of the market was computer hardware. Apple had a rough day, and as a result, Apple basically drugged the whole computer hardware group with it to the downside. And you can see that 9101 close was back beneath the 50-day clearly, and even slightly below the 20-day, which is sitting at 9104. So just a few points below that level. Again, technology, I'm worried about the semiconductors. Communication services, I think maybe internet might be a little stretched. The autos, be a little careful there as we go through the balance of September. That's part of discretionary. Those are areas that I think we could be, and of course I talked about the home builders, home construction. That's part of discretionary as well. These are all groups that have really led to the upside in 2023. And what I'm thinking is going to happen, I don't think they're going to trigger a major sell-off in the major indices. I think what we're going to see is a lot what we saw in the fourth quarter of last year, where Nasdaq didn't do very well, but we saw the transports, we saw industrials, we saw financials, some of those types of areas take over leadership for a period of time. And that's what I think will happen this year. The problem is when you're being led by industrials and financials and maybe healthcare or some of these other groups, they're not as heavily represented in the S&P 500. So if you've got pressure coming from areas like technology, discretionary communication services, that's going to weigh on the S&P 500. And so it may be a slightly higher move on the S&P. We may see the Nasdaq struggle a little bit. But I think on a relative basis, I'd be looking for strength in those industrials, financials, S&P 500 in the fourth quarter. And I think that'll lead to relative strength in the Russell 2000 as well. All right, let's move on. 10-year Treasury yield. So we are back on the move to the upside. Let me get the latest here. Last 3 days, we've seen the action moving higher in the yield. Today, we're pulling back 2 basis points. So right now, back to 4.27%. Remember, October, 433 high. And then just a few weeks ago, we had a high around 435. That's a pretty important level if we come out next week with higher than expected core inflation, or at the consumer level or at the producer level, especially the consumer level, we could see this yield temporarily break back up above 435. We could hear more and more talk, more headlines about the Fed needing to raise again, and that could be the catalyst for that second half of September problem that we sometimes encounter in the stock market. So just throwing it out there, trying to look ahead at things that might create problems for the bulls in the near term. And I think that is one thing that certainly could. That whole combination, CPI, PPI, the Fed meeting, and all the headlines and all the media blitz that goes with it, we could see some gap downs. Part of the key will be, is it selling? Do we see a lot of selling throughout the day? Do we see those AD lines take a big hit? Do we lose key support levels? Most notably, the recent lows that went in. So if we pull up, say, the S&P 500, right down around that 43.35 level, I think that was the low there. Of course, we broke out from above August 2022 highs at 43.05. So I think that 43.05, 43.35 will be a major level. I think we could go back down there. Don't be shocked. So anyway, keep that in mind as we go forward. Looking at the Nasdaq 100, same thing, maybe even a little bit worse, just because, again, I think some of these areas are very stretched. I'm going to show you one in just a second. But Nasdaq looks very similar to me to the S&P, starting to roll back over again in this consolidation phase with potentially some seasonal headwinds just ahead of us. Small caps, IWM, also continuing the move back to the downside. I would watch these recent lows, 180, 182. This whole area right here, I think, provides pretty good support. If you notice, that 179, 180 area was your resistance on the way up. So it makes sense to have that as support on the way back down. I'm okay as long as that holds. And I do suspect intraday that we're going to see money rotating more toward the IWM. So I think if the market does move lower over the next 2 to 3 weeks, I think this could be a part of the market that gets hit the least. We'll see. Transports. Transports breaking down back below the recent low, back below or close to this price support area. I think we're a little bit below it. This is where we broke out from February. That closing high on a weekly base, or excuse me, on a daily basis, 15,640. Right now we're at 15,374. So we have gone back down below that breakout level. We've taken out the recent support. Certainly looks like we've got more room to the downside on the transports. I'd be looking maybe somewhere between this breakout, which was right at about 15,000, and possibly there's a lot of highs that came in across at about 14.5. I think in a worst case scenario, 14.5 could be tested. My gut feeling is, though, that we're probably going to see rotation away from the Nasdaq and maybe into an area like this. So I don't think transports get hit as hard as possibly the Nasdaq. Again, we'll see. All right, finally, the semis. Here's a weekly chart on the semis, and this is what I wrote about in the weekly market report, our very first EB weekly market report last week. Second one will be coming out this week. If you want to get it, all you have to do is subscribe for a 30-day free trial, and you'll get the next 4 or 5. But this was a group that I talked about along with home construction that could be in for some selling in the weeks ahead, maybe in over the next few months even. When you look back, and this is going back 15 years on semiconductors, I want you to look at the highest weekly PPOs we've gotten. Here, we got up to about 7 or 8 on the PPO. Looks like maybe around 7. And at that point, you can see we actually went a little bit higher, had negative divergences come in, pulled back, and it was a year later, and we were still sitting at the same level as we were when we set that PPO high. Look in 2011, PPO high above 5, up to around 6. What happened over the next year? Sideways, even slightly lower action. How about here in 2014, middle of 2014, we went up above 5. We kept going up, but when we kept going up, we had negative divergences. Where were we a year later, year and a half later? Lower. sideways consolidation. Notice how these bring the PPO back down to the 0 line or even below it from the elevated levels. How about here in 2017, going up to about 7 on the weekly PPO? We kept going up, negative divergences formed. We didn't go up a lot, but we went up a little. And then we had the big hit. Come up here. Well, this one we just kind of went straight down. That was the pandemic. Here, this was probably maybe a little bit of an exception. We did go sideways for maybe 4 or 5 months. Then we started picking back up again, negative divergences, and we actually made one final move in the fourth quarter of 2022 before the cyclical bear market hit. And now here we are again up here at 10. And notice semiconductors bouncing off the 20-week, trying to get back through the recent highs up at about 10,500, 10,400. If they do, you're going to see a negative divergence. It could be very similar to some of these other negative divergences that we've seen after we started to get a PPO warning sign. You can see here, had a couple more tops. So I'm not saying it's impossible for semiconductors to go higher, but when I do a technical analysis, for me, it's all about evaluating risk. It's not about being, guaranteeing an outcome. It's not about me saying semiconductors are absolutely going to go higher or semiconductors are absolutely going to go lower. It's evaluating the risk. Look at history. When, first of all, we've not had the PPO ever get up to 10 on the weekly, at least not in the last 15 years. So this is unprecedented momentum to the upside, which is awesome, except we went from under 5,000 to over 10,000 in a year, maybe less than a year. Yeah, a little less than a year. That's unsustainable. A lot of people just look at the recent past. They're like, oh, semiconductors are on fire. Let me just jump in. Taking a lot of risk to jump into semiconductors right now. That's the key. That's the key takeaway. All right. Chart of the day. So I want to go in first and let me log out and go into the homepage here. If you go to EarningsBeats.com, you're a non-member, you just go to our public homepage. You can scroll down. There will be an opportunity to subscribe to our EarningsBeats Digest, our free EarningsBeats Digest. It comes with a lot of benefits. Obviously, you get 3 newsletter articles a week, Monday, Wednesday, Friday. They're usually out around 8:30, 9 o'clock. We try to get them out before the market opens, usually. Hold on one second. I'm sorry. So we try to get them out early if we can. And then we go on to provide anybody who's on this EB Digest subscriber list instructions to join us on free events. So it's another reason to be part of this community, because we do free events. We do usually at least 2 or 3 free webinars per quarter. Yesterday, we had a live trading room. We decided to reach out to our EB Digest folks and invite them in for free to come into our live trading room yesterday. So there are a lot of benefits besides just getting the 3 times a week newsletter, which in my opinion is a tremendous value, certainly worth more than the price of admission, which is $0. So name and email address, all it takes there. There's no credit card required. You can unsubscribe at any time. We'd love to have you. If you want to try our service, I really encourage you to take out a no-cost trial. It's for 30 days. You get to check out everything we do. Those trading rooms, which every Wednesday at 10 a.m. You're going to have anything that we do for our members, you're going to get for free for 30 days. So all of our portfolios, our chart lists, the list goes on and on. So make sure that you are a subscriber. Again, 30-day free trial makes a lot of sense. So what's the chart of the day for today? Well, I've been following the IWM and the QQQ. A lot of member questions have come up recently. Do I still like the IWM? I do. If you look at the relative strength of the IWM versus the QQQ, you'll see that it keeps going down. And if you recall in 2022, the QQQ kept going down. But I kept saying money was rotating. Money was rotating. We were seeing money move in. Wall Street was accumulating the QQQ from about May of 2022 on. That's when the distribution stopped, and I could see accumulation beginning to take place. It took a while, but we now see what happened to the QQQ. It exploded. Once Wall Street had their position, you run out of sellers, and Wall Street's sitting there just waiting for the masses to join in. We started seeing gap ups instead of gap downs. Pretty interesting. Go back and take a look at it. We've had net gap ups in 2023. 2022 was all about the gap downs. Anyway, what I'm seeing here in the IWM is relative strength on an intraday basis. Now, this is including gaps. So this isn't just intraday. This also is based on what happens at the opening bell. IWM QQQ has been going down. You can see just set a new low. So it's like, okay, why would you like the IWM? Well, as I've mentioned, one of the things I was doing right before the show, the reason we started just a few, well, maybe a minute or so late, was I was putting in the latest data for the intraday, so I could do my IWM QQQ intraday calculation. And here it is. And I will make this wider so you can see it a little better. So here is this is what you just looked at right here. This is what we're looking at over here on this chart. See, we went to a new low and then we bounced back slightly. So if you look at this, which includes gaps, went to a new low, bounced back slightly. So this is no different. I didn't have a chance to annotate this, but this is no different than what we just talked about. This top panel, though, is a lot different. This ignores gaps. So this ignores what the market makers are doing, what the headlines are saying, and waits until the opening bell, and then only looks at what happens after the opening bell, after that gap up or down, into the closing bell. So it's strictly what happened during the trading day, very similar to what the AD line does. If you're familiar with the AD line, we follow it all the time. And that was actually one of the reasons, that was kind of the incentive. I don't know if incentive is the right word, but inspiration maybe. That was the inspiration behind doing these intraday user-defined indexes. And so I want you to look at where we were at the end of June and beginning of July if we ignored gaps. Doesn't it look really similar to what we were doing back in June, July overall, including gaps? I mean, we were going down, double bottom. This was going down, double bottom. There's the IWM, the absolute price of the IWM down here. It looked the same, but I want you to look at what's been happening. We went up, we bounced off this July here, including gaps. And if we ignored gaps, we did the same thing. But what's happened since the end of July, early August? We've been seeing more gaps on the IWM to the downside, which is taking the IWM QQQ ratio down. And if you're invested in the IWM, it's taking your portfolio down too. It's not like, it's this phantom thing that really doesn't matter. It matters. Still taking your price action down, just like the QQQ was in 2022. But what I'm seeing during the day is money rotating away from the QQQ and into the IWM. This has gone all the way back down with the gaps. We've gone back down and set new lows. Look at where we are here. Last couple of days, I think last Friday, and then again, it would have been it would have only been this one day here. That would have been Tuesday. And then here's yesterday, Wednesday. We actually bounced back. So yeah, we were down again yesterday, but intraday, we saw a little bit of a rally on the IWM versus the QQQ. So what I'm following is this intraday. This is what I believe is taking place under the surface of the market. And so that, in my opinion, is what we need to really pay attention to. So that's why I still like the IWM. Just like I said, I liked the QQQ last year. There were some criticizing me, saying there's no way that there was a bottom. Don't fight the Fed. Don't do this. Don't do that. Well, we fought the Fed. We won. We had sentiment, which we got a reset on, which was awesome news for the bulls. Sentiment went way too far in the bearish direction. And sentiment, honestly, is still pretty bearish, which I think is good for the market. So I I think what's going to happen is I believe we're going to see more rotation away from the QQQ. I think we're going to get the leadership from industrials, financials, healthcare, those kinds of areas, which, by the way, are areas that are more highly represented in the IWM. So if you start to see the industrials and the financials begin to show more relative strength down the road, it's going to be a very good thing, a good sign for the IWM. All right, I do need to leave. It is a little earlier, going to leave before the market opens today. I don't know if that's ever happened before, but I do again want to thank everybody for joining us. We really appreciate your support, no matter what it is. Obviously, membership means a lot to us, our paid members, because that allows us to continue to do our research and to pass along the things we find, and to hopefully help everybody achieve a little bit better financial success down the road. If you like our videos, down below, please click the like button. Subscribe. When we go live, we do, if you're a subscriber to our channel and your notifications are on, you'll be notified the second we go live. So please make sure you subscribe, like the video, and also make sure your notifications are on. Have a great day, everybody. Let's see what happens with the market. By the way, let me give you the latest on the futures. Actually, I'll just tell you what the ETFs are doing pre-market. The diamonds right now are down 0.2%. Spider down 0.7%. QQQ down 1.2%. Here comes the gaps on the QQQ. And the IWM right now down a little less than 0.5%. Anyway, that's it for me. Have a great day, everybody. Happy trading.